Okay, so you own some Bitcoin, maybe a whole one, maybe a fraction sitting in an app on your phone. And the story you've been told about what you own is simple. It's digital gold. 21 million ever. Nobody can print more. Scarcity plus demand equals price. And holding one is like holding a small piece of a finite thing. That story's fair enough. The cap is real, written into the code since the network's first block in January 2009, and no central bank can override it. Compared to a currency a government can expand at will, that's a genuine structural difference, and it's why a lot of serious money now sits in this asset. But the digital gold comparison hides something, and it's hiding in plain sight. Gold in a vault costs you a storage fee, and then it sits there, inert, for 1,000 years. Bitcoin doesn't sit. Roughly 450 brand new coins are created every single day and handed to strangers you will never meet. Not sold, not earned from you in any transaction you agreed to. Created out of nothing and given away every 10 minutes on a schedule that has not paused once since 2009. That is your storage fee. You've been paying it since the day you bought, and nobody has ever sent you an invoice for it, which leaves the question this whole thing rests on. There's no company here, no revenue, no dividend, no board of directors, no product being sold. So who is paying those 450 coins a day? And what precisely are they buying with them? You are. Every holder is. And once you see how that bill gets issued, Bitcoin stops looking like an asset you own and starts looking like something closer to a subscription. A continuous payment to a network. In exchange for that network continuing to agree, your coins belong to you. Start with the strangest part of the whole arrangement. The thing at the center has no business model at all. The protocol itself is just a ledger and a set of rules. It has no headquarters, no employees, no revenue, no bank account. Thousands of computers worldwide run it voluntarily, each keeping a complete copy of every transaction ever made. Nobody is paid to do that, and nobody can be, because there's nobody to do the paying. Every other name attached to Bitcoin exists because of that vacuum. There are the miners who are paid to secure the ledger, an industrial energy business that happens to be denominated in Bitcoin. Publicly traded miners file with the SEC and sign multi-year power contracts with grid operators in West Texas and upstate New York. Their income statements read like a smelter's. Megawatt hours in, a commodity out. There are the exchanges, Coinbase, Kraken, Binance, which sell you access. Ordinary financial businesses with a very ordinary model. Take a cut of every trade in either direction in any weather. And there are the funds. When the SEC approved spot Bitcoin ETFs in January 2024, it created a new species of Bitcoin owner, someone who owns a share in a trust that owns coins held by a custodian. 3 steps removed from the ledger, and perfectly happy about it. 3 businesses standing around one thing that isn't a business. And each of the 3 has worked out a different way to charge you for standing near it. Buy on a retail app, and you pay the spread plus a fee. The spread is the gap between the price the app buys at and the price it sells to you at. An invisible markup baked into the quote, before any fee appears on your screen. Together, that can run north of 1% per side, so call it 2% round trip. On a $5,000 purchase, that's $100 gone before the price has moved at all. Go the fund route and you pay an expense ratio instead. An annual management fee, quoted as a percentage, skimmed automatically out of the fund whether it rises or falls. BlackRock's spot fund launched around 0.25%. Grayscale's converted trust charged closer to 1.5% a year. Same coins in the vault. 6 times the annual toll, compounding quietly for as long as you hold. Or you take self-custody, holding the coins yourself, with no company in the middle, and your cost turns into hardware. A dedicated device runs somewhere in the low hundreds of dollars, one time, plus the permanent responsibility of not losing the recovery phrase that comes with it. 3 routes, 3 completely different price tags. And here's the part that should bother you. The one layer nobody charges you for is the ledger itself. The protocol has never billed anyone a cent. It has no mechanism to. So if nobody is charging you for the ledger, why has somebody been burning electricity to maintain it every 10 minutes for 17 straight years? To answer that, follow the coins backwards to where they come from. Think of it as a lottery running on a strict timetable. Every 10 minutes on average, one prize is awarded. The prize is fixed in advance. Since April 2024, it's 3.125 new Bitcoin, plus whatever transaction fees are attached to that block. More tickets improve your odds, and a ticket is bought with computing power, trillions of guesses a second, each one a raw attempt at a number that satisfies the network's puzzle. Three things govern this machine. Each is simple alone. It's the combination that gets strange. Start with the block subsidy, those brand new coins created from nothing, handed to whoever wins. It began at 50 per block in 2009. It halved to 25 in 2012, to 12.5 in 2016, to 6.25 in 2020, and to 3.125 in April 2024. It keeps halving roughly every 4 years until, sometime around 2140, it reaches zero. Notice what that schedule really is. Every 4 years, an entire global industry takes a 50% revenue cut on a date everyone has known about for a decade, whether the market is ready or not. That's not monetary policy in any normal sense. Nobody votes on it, it's arithmetic, and it's coming for them regardless. Next, hash rate. The total guessing power of every machine on the network added together. Its commercial cousin is hash price, the number miners check every morning. The revenue a given chunk of computing power earns in a day. Think of it as the going rate for a day's work. It moves for exactly two reasons: what Bitcoin is worth and how many competitors switch their machines on this week. And then the one that breaks everything, the difficulty adjustment. Every 2 weeks or so, the network measures how fast blocks are being found. Coming too quickly because more machines joined? It makes the puzzle harder. Too slowly? Easier. The target never changes. 10 minutes, forever. Put those three together and normal business logic falls over. In a factory, adding a second production line doubles your output. In mining, if the whole industry adds a second production line, output does not move by a single coin. The network issues 3.125 Bitcoin per block, whether 10 machines are competing or 10 million. All that extra hardware does is split the same fixed price between more claimants at higher total cost. This is the single most counterintuitive fact in the system, and everything downstream runs off it. It means mining is a business where success mathematically guarantees your own margins compress. It means a rising price never makes miners permanently richer. It just invites hardware in until profitability is competed back down toward the cost of electricity. There is no other industry on Earth where doubling the sector's effort produces exactly zero additional product. If you can name one, I'd like to hear it. 450 coins a day, billed to everyone who already holds, and completely indifferent to how much anyone spent trying to catch them. Which leaves the obvious follow-up. If the miner's revenue is fixed by the protocol and their costs are real and rising, where is that revenue coming from? From dilution? From you? Work it through. At 3.125 coins per block and about 144 blocks a day, the network hands out roughly 450 fresh Bitcoin every 24 hours. Multiply that by whatever price you like. At any price the market has seen in recent years, the annual figure lands in the billions of dollars, transferred every year from the people who hold to the people who mine. Nobody sends you a bill. There is no line item. The mechanism is that miners receive newly created coins and to cover power and hardware and debt service, sell a large share of them into the market. Your slice of the fixed 21 million shrinks fractionally every 10 minutes, and the coins diluting you are sold to buyers who might otherwise have bought from an existing holder, from someone like you. That is the security budget, your subscription fee, debited every 10 minutes, whether or not you open the app. And what it buys is real. The Cambridge Center for Alternative Finance, which has tracked the network's electricity use for years, has published annualized estimates in the low hundreds of terawatt hours. National scale consumption, roughly in the territory of a country like Poland, with genuine uncertainty bands around it because nobody can see inside every facility. That energy is precisely what makes rewriting the ledger economically absurd. To reverse transactions, an attacker would have to outspend the entire global industry continuously forever. The electricity isn't a side effect of the design, it is the product. There's a second cost, and it isn't financial. What you own is not a coin. There is no file, no object, no token sitting anywhere. There is a ledger entry and a private key that lets you sign a message authorizing that entry to move. Ownership is the ability to sign, nothing else. That distinction is invisible right up until the moment it isn't. If your coins sit on an exchange, you don't hold the key, the exchange does. What you hold is a claim against a company, which is a legally different animal, and the convenience is deliberate. App custody is smooth, recoverable, password resettable, and every one of those features exists precisely because somebody else is holding the key on your behalf. So the choice is a company that can lose your coins, or you, who can also lose your coins. There is no third option where somebody else carries the risk for free. That's not an oversight nobody has gotten around to fixing. A system built so that no trusted party is required has, by construction, nobody to appeal to, including on your behalf. Chainalysis and others have estimated that a substantial share of all Bitcoin, with figures around 20% commonly cited, may be permanently unreachable, sitting in wallets whose keys are gone. That's an estimate built from Chainalysis rather than a census, and it should be read as one. But it points at something true. This is an asset where the failure mode is silent, permanent, and entirely yours. There's a documented version of that sentence with a name attached. James Howells, an IT worker in Newport, Wales, mined Bitcoin in 2009 when a laptop processor could still win blocks. He stopped, dismantled the machine, and left the hard drive in a drawer. In 2013, it went out with the rubbish and into a municipal landfill. The coins on it, reported at around 8,000, are still sitting on the ledger today, visible to anyone who cares to look up the address, unmoved for more than a decade. He has spent years petitioning the local council for permission to excavate the site and has been refused on environmental grounds. The courts have not sided with him either. The ledger says those coins exist. The ledger also says they belong to whoever can sign for them. Nobody can. That gap in between a balance being real and a balance being reachable is the part no price chart will ever show you. Both of these costs, the dilution and the custody, stay comfortably theoretical during a bull market. They stop being theoretical in a very specific sequence. Here's the sequence, and then two documented cases where it ran all the way to the end. Price rises, so mining gets lucrative, so operators order machines. The machines cost more than the operators have on hand, so they borrow, often against the hardware itself, pledging the miners as collateral for the loan that bought them. And here's the trap in the arrangement. Every machine that plugs in makes the puzzle harder for every machine already running. The industry's own expansion drives the difficulty adjustment upward, which cuts what each machine earns. The debt was underwritten at a profitability the borrowing itself destroyed. Now the operator needs a high Bitcoin price and cheap power just to service the interest. If the price falls or power costs spike, or a scheduled halving cuts revenue in half overnight, the squeeze arrives from three directions at once. And the only liquid asset on the balance sheet is Bitcoin, which has to be sold into a market that's already falling. Core Scientific ran that exact sequence in public. It was among the largest Bitcoin miners in North America, operating data centers across several states with hundreds of thousands of machines. And in January 2022, it went public through a shell company merger. A faster backdoor onto the stock market than a traditional listing. In a deal reported to value the combined company at roughly $4 billion. Its model paired self-mining with hosting, running machines for paying clients alongside its own. Then 2022 happened. Bitcoin fell from its November 2021 high near $69,000 to around $15,500 by November 2022. Natural gas and power prices climbed through the year. Network difficulty kept ratcheting upward as the machines ordered during the boom finally arrived and switched on. And one of its significant hosting customers, the crypto lender Celsius, filed for bankruptcy in July 2022, leaving money the company said it was owed and was unlikely ever to see. Every input moved the wrong way simultaneously. The debt secured against those machines had been taken on when hash price was several times higher. In December 2022, the company filed for Chapter 11 in the Southern District of Texas. It kept mining throughout, restructured, and emerged in January 2024. What it proves is that the difficulty adjustment is not a market participant anyone can negotiate with. It raised the bar mechanically while revenue was collapsing, and the leverage did the rest. Core Scientific was on the receiving end of the subscription everyone else pays into, and discovered that the payment is fixed by the protocol while its own costs never were. The second case is older and colder, and it's about the other cost, the one where you never touch the key. Mt. Gox began life in Tokyo as a site for trading collectible game cards, pivoted to Bitcoin, and by 2013 was handling the substantial majority of global trading volume. If you wanted to buy in that era, you very likely went through it. Users treated their balances the way anyone treats a bank statement, a number on a screen representing a thing that was definitely there. The first warning signs were withdrawal delays, coins taking days instead of minutes, blamed on technical issues with the software. Then in early February 2014, withdrawals were suspended entirely and stayed suspended, with explanations that changed week to week while roughly 850,000 coins were unaccounted for behind the scenes. On February 28, 2014, the exchange filed for bankruptcy protection in Japan and disclosed the shortfall. About 750,000 of those coins belonged to customers. Around 200,000 were later located in an old wallet the company had forgotten it controlled. The users' entries were still sitting on the ledger, exactly where they'd always been. They simply belonged to whoever held the keys, and that was no longer anyone acting on the customer's behalf. Creditors then spent more than a decade inside Japanese insolvency proceedings, with distributions finally beginning in 2024. 10 years of waiting for an asset that settles globally in minutes. And before anyone files that under ancient history, 8 years later, in November 2022, FTX collapsed with billions in customer assets missing. Same structural fact, a decade apart, at a company with vastly more regulatory scrutiny and far better known backers. 2 failures, 2 mechanisms. One was a business that misjudged its capital structure against an adjustment algorithm that doesn't negotiate. The other was hundreds of thousands of individuals who owned a claim against a company and believed they owned Bitcoin. Neither involved the protocol malfunctioning. The ledger worked perfectly throughout both, which leaves one question worth answering properly. After all of that, what does holding this thing pay you? The optimistic version is genuinely striking, and it's the reason anyone is having this conversation at all. Take a documented entry point rather than a lucky one. In December 2018, Bitcoin bottomed at roughly $3,200 after falling all the way from its 2017 peak. Anyone who bought it that low and simply never sold has been sitting on a tenfold return for every stretch since early 2024, in which the price has held above $32,000, which is most of it. Go further back to Laszlo Hanyecz paying 10,000 coins for 2 pizzas in May 2010 at a rate of well under a cent per coin, and the multiple stops being a return and becomes a piece of financial folklore. None of that is a projection. It happened. The realistic negative version is equally documented and gets discussed a great deal less. This asset has repeatedly fallen more than 70% from its highs. December 2017's peak, near 19,700 to December. 2018's trough, around 3,200, is roughly an 84% decline. November 2021 to November 2022 is roughly 77%. Someone who bought at the top in late 2021 waited until around March 2024, more than 2 years, merely to see their original number again. If you needed that money at any point in between, the long-term chart was irrelevant to you. The engine collapses into a single sentence. Your return is entirely a function of what future holders are willing to pay, minus the security budget you fund through dilution, minus the fees you pay at every layer you touch. There is no cash flow underneath to catch you. That isn't a criticism, it's the design. A network with no issuer has nothing to distribute, and the parties who have most reliably profited from all of it aren't the holders. Bitmain sells the machines whether they ever pay for themselves or not. Coinbase takes its cut on the way in and again on the way out. BlackRock and its competitors collect their annual percentage on assets under management in every market condition there is. Companies like Strategy assembled treasuries of hundreds of thousands of coins funded largely through convertible bonds. Borrowed moneylenders can later swap for shares. A leveraged bet that works spectacularly on the way up and carries obligations that don't have on any schedule. So it comes back around to what you bought, not a thing in a vault, a position on a ledger, and the ledger charges rent, paid in dilution, every 10 minutes to a global industry burning national quantities of electricity so that everyone keeps agreeing your entry is yours. None of this is a recommendation to buy or sell anything. It's an explainer on how the machine works, not financial advice, and wherever I've given an estimate rather than a confirmed figure, I've said so. Arithmetic, not policy. Funded by dilution, not by nobody. And ownership means the ability to sign. Everything else is a claim against a company. If one of those three is new to you, that's worth a comment because it tells me which part of this deserves its own video. The subscription renews automatically. Cancellation just means selling to the next subscriber. And the protocol will keep running either way. It doesn't know your name, it doesn't know your cost basis, and it has never once adjusted itself to accommodate anybody's timeline.